Welcome to the Killik & Co podcast on the 26th of August. It's a shortened week for the bank holiday, but the markets in London are playing a little bit of catch-up for Europe that was open yesterday. An interesting week last week, particularly around the forum at the Jackson Hole, where many of the leading central bankers around the world were present. And the question mark is, what sort of deals were struck there? Were there deals to cheapen the euro? Were there deals to keep interest rates low? And what is happening with the ECB at the moment in light of what are deteriorating numbers that are coming through in the European economy? Certainly we are seeing yields come lower and some level of expectation that they're going to move their thought process along from just cutting rates to possibly QE. So let's start off with just some of the sort of market charts that we have for last week. Again, starting off with this US 10-year, want to continue to reiterate that whilst there's plenty of talk about rates firming, tightening financial conditions, yields continue to decline at the moment, and it really is a sort of an interesting picture that is emerging here, that the bond market is still fretting a little bit more about possibilities of a slowing economy or indeed lower inflation further down the line at the moment, and this is slightly at odds, of course, with the more optimistic tones that are being seen with the current data that's coming through for the US economy. So still around 2.37% on a 10-year yield. That is higher than what is being found in Spain at the moment, because you can see this sort of final sort of a lurch lower in Spanish yields, and I'm putting this up really as a proxy for most European yields at the moment, down to 2.18%. So that really has, just in the course of August, declined very significantly from 2.5% to 2.18% as we film this podcast. So really continue to bring these markets lower on yields, and I think continuing to have a positive impact on equities. It really just evolves around this whole concept of what is an acceptable rate of return now for investors when they are reviewing asset classes, and the more these yields come lower, the more attractive equities are looking as an asset class and pushing markets higher. Oil is another factor here which is playing its part. We've seen oil just in the course of June as geopolitical tensions started to rise, peaking out at around 104. But it's been quite a sharp retracement in the oil price over the course of the last couple of months, now coming down to sort of lows last seen sort of earlier in the year. So crude oil prices lower, and that will be acting as a welcome relief to economies at the moment, particularly in the US, where it acts as quite an important tax on the consumer. Dollar-wise, well, the dollar continues to strengthen. It comes back to this point about ever since Mario Draghi's comment earlier in the summer, back in May time, where he spoke about the rate of the euro. It's really been a continued message that's been coming out of European economies at the moment, that the high rate of the euro is impinging on the ability of the European economies to recover. The net result of that is that there's been this continued sort of drive and need to see the euro lower, and it came off quite sharply again as the course of last week, and it has caused a little bit of speculation around trading desks this morning that some sort of deal was done between the US and the euro to keep the euro softening at the moment. Of course, this is helping some of the exporters in Europe to become more competitive, and we'll take a look at some of the stocks that are on our buy list, which should be beneficiaries of that particular trend. This is the Euro Stoxx, so this is what is happening to European stock markets, and as you can see, the geopolitical tensions did cause quite a sharp fall in equity markets towards the end of July, back into the early part of August. But since then, that has been bought into, and we've seen a recovery in markets. It's really enforcing this trend at the moment that markets don't want to come back far. Every time we see a little bit of a shakeout, it is offering the opportunity, I suspect, for the tremendous amounts of cash that sits around and being generated at the moment, that is having a more limited choice of investments because of the high rate of bonds at the moment, for example, that the equity market continues to see some flows coming back into it. So, as I say, these retracements are being bought into, as evidenced by the Euro Stoxx at the moment, but not necessarily being driven by normal trends of economic growth, but being trends of what's going on in other asset classes. And so it's a relative performance game at the moment. Just a quick look at some stocks that are of interest to us at the moment. We're going to comment just briefly on WPP this morning. It's been on our buy list for a while now. and on the face of it, looks to us a cheap global play in the media market. They announced their results this morning, first half results, and whilst the headline showed very modest growth of around 1.5%, that in itself was ahead of expectations. If you strip it back to the constant currency, because the strength of sterling did impact on businesses like WPP, the underlying growth that they're seeing at the moment is around 15%. So really, the company seems to be in very good shape. Balance sheet is strong, throwing off lots of cash. They're raising the dividend by around 10% and upping the share buyback plan by around 390 million this morning. So that has impressed investors, and those shares are moving higher. Just in terms of some of the European stocks that we would continue to reinforce, just if you subscribe to this view that we're seeing at the moment of this policy of cheaper currency in Europe, and maybe some more money coming through from the ECB, maybe some more reforms within governments to just lay off these sort of deficits for a time being, is all supportive, we think, to European industrials. And Linde really reflects that model very, very well. And again, if you want to know a little bit more about that, your broker will have a copy of our most recent research note, which was a buy. Volkswagen as well, you can see, had quite a sharp retracement, but that trend is looking similar to the Euro Stoxx index, so it's a good correlator to financial markets, and we like Volkswagen. BASF is on the buy list, and Sanofi as well, a couple of other European names to just mull over. So really, it's been a constant theme for us for some months now, is to make sure that you are up to weight in terms of some European cyclicals, and that is something which we would continue to enforce. Really, to final look at the diary ahead, not much to look at. We've come through this period where it's been the sort of Q2 report season. That, to some extent, is coming to an end. So you can see the sort of lack of dark black on that means that there are fewer companies on our list which are of relevance today. And indeed, on some of the economic signals this week, we've got a little bit out of the US, which is a follow-up from the sort of PMI data, inflation data that we saw out of Europe. And just in terms of stocks, Melrose Industries is one covered stock which will be reporting its results on Thursday of this week.